So we are saying that we cannot shy away from saying that the government of the day is supported by the private businesses and the small medium enterprises. So we are looking at micro enterprises and we are saying these are enterprises that have less than 10 employees. For example, if today you start a cyber cafe and you have maybe 15 computers, you can decide, let me employ 2 people who are going to assist in the management of this business. Therefore, that can be classified as a micro enterprises. Then we have small enterprises, which has an ability to employ 10 to 49 employees who are working for you. Maybe you started a business of baking bread, and you want this bread to be supplied across the town. So you employ 49 people, then we can say that is a small enterprise. Then the last category is the medium-sized enterprise. And here we are talking about the number of employees between 50 to 99 or less than 100 employees. This form of enterprise is referred to as the medium enterprises. So we are looking at the Vision 2030 of Kenya, which tried to envisage that these categories of business are found mostly in the informal sector.
Just a question, Dan.
Yes, yes.
So we do not necessarily classify according to the turnover or the income. So it's purely based on the workforce.
You know, when you talk about income is relative. You see, because these are businesses that are engaged in different activities. When you start seeing the turnover, you might find maybe an organization has employees of maybe 20, but in terms of sales, it even sells more than those organizations that have a huge number of employees. So mostly when you look at the economic survey that was done, the classification was based on the number of employees. So here we are basing our facts on the survey, the economic survey that was done in 2017. Is that okay? But other researchers maybe have come up with other classifications. But according to that survey that was done, the main focus was on the number of employees rather than the turnover in terms of the revenues or the income they collect. Is that okay?
Yes, yes.
So we are talking about the informal sector. And informal sector is a sector that has been there for a very long time. Look at the Juakali sector, for example, is a form of an informal sector. So one of the characteristics of informal sector is the issue of reliance of indigenous resources. So these are resources maybe that are indigenous in nature. So what do you understand by the word indigenous?
It's the old things. What would I what is the word to use? Yes, hizo vitu za kitambo. It's not up to date with the latest developments. Yes.
So exactly, for example, look at the Juakali sector. They are still depending on some metals that were used a long time ago. And we have new resources that have been there, but they don't want to depend on that because of the cost that is involved in these items. Then the other issue is family ownership. When you look at informal sector, you realize that these are family businesses where maybe a parent starts a business and leaves the business to the kids, who later leave the business to their grandchildren. Then this business also operate in small scale operations, where when you talk about small scale operation, we are talking about the target. They are targeting the local customers in that area. because of their size of business, because of their market inabilities and other things. Then this business also are labor intensive, and they do not like to adapt on technology. So you find that we have a lot of people who are working for this sector, and it is very involving, because you have to wake up very early in the morning and also leave very late in the evening. Then the other thing is that the skills acquired from an outside of the formal sector sometimes cannot be regulated. The other thing that can also be regulated is the issue of competition, because of the nature of what they do. So it becomes very difficult to understand the market competitiveness. So according to the Micro and Small Enterprise Act of 2012, we have the various definitions of the small medium enterprises, which includes the annual turnover. So that is what we are now talking about.
Yes, yes, yes.
So according to the Act of 2012, now they came up with various definitions of medium and small enterprises. So micro enterprises is a firm whose annual turnover does not exceed 500,000 shillings and which employees are less than 10 people. So here we are looking at the turnover. If your turnover is less than 500,000, then we are saying this is a micro enterprise. Small enterprise firm is a firm whose turnover ranges between 500,000 to 5 million shillings, which employs between 10 and 50 people. So if your turnover is below 5 million, then we are saying you are in the small enterprise firm category. So before we jump into the types of businesses, I will also display something here. We are talking about the number of employees. Small, medium enterprises have little or less number of employees who support their day-to-day business activity. And most of these small, medium enterprises are normally operating in a certain local area. For example, within Nairobi, you can get them in Kamkunji. You can get them maybe in the informal settlements and maybe in the outskirts of Nairobi town. And in terms of management, these people do their businesses maybe by the owner or a small group of individuals who are given the mandate to manage the business. But some of these people do not have the knowledge of how management works. So they are using what they know to manage some of these businesses. Small, medium businesses are usually the sole employment or as part of hobby or side hustle. Some people decide to start businesses because that is the way they are going to survive. They don't have any other option. But some people decide to start these businesses because they feel, because you have this extra time, why don't I start a side hustle so that I get extra income? Okay. Others start these small businesses because of the hobby. They like doing that business. Then they exist in one or more sector of the economy. So we have different sectors of economy. For example, we can have the transportation sector. We can have the agricultural sector. We can have the... Which other sector can you say?
Agriculture.
I've said agriculture.
Manufacturing.
Manufacturing, yes. Retail sector.
We have talked about retail. Yes, retail.
Okay. Then the other characteristic of these formal organizations is that they are characterized by ease of entry and exit. So you can start this business feel that like this business is not working, you move to another business. That business is not working, you engage another business, and like that. So there's a high turnover rate where you can still enter another market, try your luck. If it works out, you continue. If it doesn't work out, you move to another business. They also rely on indigenous resources. And we have said indigenous resources are resources that maybe are outdated resources. Then, or they are the natural resources that have been there. So they don't base their facts on new resources that are there in the market. Then they face stiff market competition. And competition here, we are saying a competitor is a person or an organization that does the same business as you do. So if that is the case, then it means competition is very stiff in small, medium enterprises. And this forces some businesses even to close. Look at a case where someone has started an M-Pesa. And when you look at that street, you realize we have more than 50 M-Pesas. And you start wondering, how do these people survive in their business? For example, when you go to some of these streets in town, you find that one form of business cuts across the whole lane in the street. So you wonder how do these people survive. And that is why we are saying we have a lot of steep competition in these businesses. So this also takes us to the types of business enterprises. And when you look at the types of business enterprises, we are looking at how business takes different forms in the market. And one of the business type is the sole proprietorship. The second one is partnership business. The third one is private companies. And the other one is public companies. So let's begin with the sole proprietorship. Let's begin with sole proprietorship. And we are saying a sole proprietorship is a business that has a single owner. One person today decides to start a business, then automatically it becomes a sole type of business. And sole, the other word of sole is one. The other part, the name of sole is one. So the person is responsible for investing capital in the business and running the day-to-day affairs of the business. So you can decide to borrow so that you start your business, or through your savings, you can decide to invest your business. The owner takes total responsibility for running the business and bears the risk of failure of the business. So you can fail in this form of business, regardless of your experience, even in the industry. So it requires a lot of research. Before you start a business, you need to do a lot of research so that you understand how the business works. So the person is liable for all the losses or profits. This means that in the event you make profits, you eat the profit alone. In the event you make losses, you feel the losses alone. So in business, since they are viewed as one and the same thing, so you cannot separate a sole proprietor from the business. For example, if you go to a barber shop today, you cannot separate the barber shop from that business. So they go hand in hand. So the law does not distinguish between the owner of the business, hence unlimited liability. So when you talk about unlimited liability, it means that in the event you get losses in your business, you carry the cross alone. The other thing is that there is no excuse for legal compensation that might arise while running the business. But I think nowadays, because of insurance that have come up, they're trying their level best to insure some of these businesses so that in the event of eventuality, they can always indemnify some of these risks or pay back a certain amount depending on the level of risks and the perils. Then with the sole proprietor, the owner is the boss and needs not to consult anyone in decision making. So you are the boss, you make your decisions alone. If today you decide to wake up at 10, that is your own problem. But in the evening, if you don't have the money or the profit, then that also is your own problem. And that is why when you go to the sole proprietor business, you find that these people are overworking themselves. They even wake up as early as 5, 3 to go look for stock, to go look for inventory, to run their business, to go look for customers. And they end up even resting as late as 11 in the evening. A sole proprietor form of business ends if the owner becomes bankrupt or dies. So the only way to dissolve this type of business is when you are bankrupt. You do not have money to support your day-to-day activities. Or in the event that you die, then automatically this business will end just like that. So what are the characteristics of sole proprietorship type of business? The first characteristic we said is sole ownership, where only one person runs the business, or one person is in charge of everything that happens in that company. Then you have unlimited liability. And here we are saying, in the event you get losses, you carry the cost alone. And in the event you get profits, you also take the profits alone. Then the other characteristic that is very critical is limited working area. You are just limited to your small, maybe stall, or to your small building that you have acquired. And therefore, you are just limited in that space or a certain locality in your area. For example, if you come from Buruburu, your business is just limited to that area in Buruburu. Or when you're coming to Embakasi, your business is just related to Embakasi. Then in terms of capital, the sole trader or the sole proprietor is in charge of the capital and is able to manage and account for that capital. Then the other thing is minimum legal formalities. So you only need a license to start a business or a permit to start a business. So you just walk into the local offices of the county government and they offer you a license or a registration certificate so that you can just start your business right away. Then willful selection, commencement, and closure. So you can decide to start that business anytime you want. And you can close it anytime you want. You can shift from one business to another anytime you want. So what are the advantages of a sole proprietorship form of business? Number one is that it is simple to create and to start. So you just need a capital of maybe 1,000 or 5,000 or 10,000 or even 50,000, depending on which business you want to start. For example, if you want to start selling Mutumba clothes today, you just need maybe 3,000 to 4,000. Walk into Gikomba and you're able to get a bale of clothes and you start selling the clothes. Least costly form of ownership to begin. So it's very least costly. You only need maybe some few documentation where you can pay 1,000 to get such documentation and you're good to go. Then the issue of profit incentives. Once all expenses have been paid, the rest is called retained profit. And some of these businesses, sometimes even they do not pay taxes and you end up getting a lot of money. Then decision-making is on an individual and the individual can decide to do changes as he or she wishes. Then we can talk about No special legal restrictions. It is the least regulated, so it does not need regulations. It is the least regulated. Once the Kanjo or the local askaris come to collect their dues every day, then you are good to go. And lastly, it is easy to discontinue. So what are the disadvantages? What are the disadvantages? Number one, unlimited personal liability. Remember we said in the event you get losses, you carry the cross alone. The other disadvantage is that we have limited skills and capabilities. You find that these people do not have what it takes in terms of the skills. They do not have the training to manage some of these businesses. Some of them even do not keep records of their business activities. And these might affect the whole process of trying to grow your business and making your business to become better and better. Then we have high state of isolation. We have high state of isolation. These businesses normally have cases of isolation where people do not want to get even feedbacks from customers. They do not want to have new ideas on how they can improve their business. They believe what they understand is what is right and the best way to run their businesses. Then the other thing is limited access to capital. Other than the owner's savings, they can only get some small amount of loan from the banks, or even get a small amount of money by giving some collateral, maybe a logbook or a title deed, so that you can access money from the bank. Then we have lack of continuity of the business. So in the event the sole proprietor dies, then the sole proprietor dies with the business. He or she dies along with the business. So let's have a commercial break for 2 to 3 minutes or 5 minutes, then come back and wind up. Is that okay?
Okay.
Let's continue. So partnerships is the second category of business enterprises. And we are saying a partnership is where two or more people come together to do business as co-owners. And the main purpose for partnership is to be able to make profits. So when two or more join together to start a business, then automatically we are saying this is a partnership form of business. It is another form of business where people come together to agree for a common good. And once they get the profits, they are going to share the profits amongst the partners. And there has to be a written agreement where all partners are supposed to share or to sign. In the event they get profits or losses, the losses are shared amongst all the partners of that business. So the agreement normally that they sign is called a partnership agreement or a partnership deed. And the content of a partnership deed or agreement has the following contents. The first one is the name of the partnership. And the name basically is what will identify you in what form of business that you are doing. It creates the identity of your business. Then the other thing that the deed has is the purpose of the business. Why are you doing the business? What do you want to achieve? What do you want to engage in? You need to tell us exactly. Then the other one is the domicile of the business. So domicile, what is domicile?
Where it is situated, where like you are.
Or the domicile, huh?
Yes.
Or you also need to tell us the location where you locate your business, so that at least the government knows. In the event they want to get you, where can they get you? Then the duration of the partnership. How long are you going to be in partnership business? So you need to tell us those details. And maybe after every year, you need to review the partnership date so that the government is aware whether other partners have left the company or other partners are still there, and things like that. Then we are talking about the name of the partners and their legal address. So every partner must identify him or herself so that they know. Then the contribution in terms of capital that every partner has contributed for the business is also indicated in form of percentage. Then agreement on how the profits or losses will be shared. And normally it is very important to understand how are we going to distribute the money that we get. And this also is normally done with the various percentages or the ratios of the contributions of the partners. Then procedure for expansion through additional new partners. In the event you want to introduce a new partner, you also need to indicate in the document. Then agreement on distribution of assets and any interest, maybe interest on capital. You need to tell us how you are going to distribute some of those assets. Then the issues of salaries, drawings, and expense accounts for partner. You need to create a partnership account that will help you to spread on how you're going to pay the various partners. So what are the advantages of partnership? What are the advantages of partnership? Partnership is easy to establish compared to companies, because once you sign the partnership deed, then you're good to go. Then we have complementary skills. Different partners bring different skills, and these skills go a long way to help improve the business and make the business to become a better place. Then we have division of profits. Partnership divides profits amongst the various partners in the business. Then we also have large pool of capital, in that every member of the partnership brings capital to the business. And this will be a larger pool of capital compared to a sole trader or proprietor. Then we have ability to attract limited partners. So you can attract other partners who can come and support a business. Then minimum government regulations and taxation. So the government does not tax these people huge amount of money compared to companies, where companies have even corporate tax, they have other taxes to pay. Then the other thing about partnership is that we have some level of flexibility. You can decide to do different forms of businesses in your engagement. So what are the disadvantages of this form of business? What are the disadvantages of this form of business? Number one is that there is unlimited liability. There is unlimited liability. It means that in the event we have losses, these losses are shared among the partners. Therefore, the portion is very small, and that is why we are saying there is unlimited liability. Then the other thing is that it is difficult to dispose the partnership interest, sometimes because you have to dissolve the partnership for purposes of disposing the interest. Then lack of continuity. In the event one partner leaves the partnership or dies, sometimes the partnership might be dissolved. or you might end up introducing a new partner to take that place. And in the event a new partner comes in, you have to dissolve the old partnership. Then we have potential for personality and authority conflict, where people want to feel that they are the ones who are supposed to take control. And in the event this happens, then we have some cases of personality where some are not happy, then issues of conflict arises, and this is very dangerous. Then partners are bound by law of agency, and therefore they should exercise good faith and reasonable care. So remember, a partner is an agent of the partnership because they are the ones who try their level best to spread gospel of the partnership. Therefore, you need to, some partners might end up not being the best in terms of being an agent of the business. So we have two types of partners. We have general partners and we have limited partners. Limited partners are partners who have invested in the business venture and they have limited liability for the partnership debt. But the general partners normally take the larger chunk of the liability of running the business. So the other thing we are going to talk about is limited company. When you look at limited company, we are saying limited companies are companies that are owned and run by the directors, the board of directors or shareholders who come together to pool resources for purposes of starting the business. And remember, when you talk about limited company, the limited company is separate business entity compared to the directors who run the business. And that is why we are saying a business or a limited company can sue and be sued in a court of law. So you can take a company to court. And remember, the company is separate from the business leaders. And that is why it has perpetual existence and it can be sued. Therefore, it is considered as an artificial person. The value and type of shares held determine the limit of shareholding liability. Remember, every business normally gives shares to its members. So once you buy a share, you become part of that company. Look at companies like Safaricom. These are public limited companies, and they normally float their shares in the stock market so that people get an opportunity to buy these shares. Then there are two main forms of limited companies where we have public limited companies and we have private limited companies. So let's begin with the private companies. A private limited company is a form of small business entity in which the owners have the liability of the business. And the maximum number of shareholders in a private company is normally 50, below 50. And the minimum is normally two who can start a private limited company. The finance for starting a limited company may be raised by issuing shares, but in private businesses, sometimes it becomes difficult because maybe some of these private companies are family businesses and they might lock the business maybe to a certain category of their family members. Look at a company like Naivas, for example. It's a private limited company and it is a family business. So most of the time, the shareholders are the members of that family. In Kenya, a private company can commence its business as soon as it possesses the certificate of incorporation. So the process of registering a company is normally referred to as incorporation. So you incorporate a business. So once the private companies get the certificate of incorporation, they are good to go and commence their business. But there is a clause that says However, if the company does not commence business within 1 year of its incorporation, then the company automatically can be wound up, it can be closed. So we have two documents that are very critical when you're operating a company, where we have the Memorandum of Understanding and the Article of Association. So what are the advantages of private companies or companies? Number one is the ability to attract capital. So they have a wider pool of resources and they're able to attract a lot of capital from the shares, from maybe loans and other forms of capital. Then ability to continue for an indefinite period. Remember, we are saying companies have perpetual existence, in that in the event one director has retired, they will always look for a new director to ensure that the business is a going concern. Then we have the ability to transfer ownership. Sometimes you can transfer ownership of the company from one company to another. Look at a case of Finlay's Tea. They transferred their ownership last month to a company in Sri Lanka. Did you read the story?
The Ekaterra.
Yeah, I don't know the name of the company, but it's from Sri Lanka.
Yeah.
Then owners are held personally liable for fraudulent or illegal act. So the company can sue you as an owner of that company in the event you maybe misappropriate funds or you act in a fraudulent or an illegal act. Then disadvantages of limited company. Disadvantages of limited company. The process of incorporation is lengthy and complex. So it takes a lot of time to register the company because they need to do some due diligence of what you're doing. They need to do some analysis and many things. Managerial incentive may be eroded. So some people might take advantages by having some per diem every time you do something.
Then your screen has not moved to the next.
It has not
Just
moved.
like
Just a minute. And right now,
it's okay. No, go back.
what is your screen saying?
Advantage. We are still at the advantages.
Yeah, just in the middle we have disadvantages.
Oh, okay. Sorry.
And I didn't put it in a slide.
Okay.
Then managerial incentive, we are saying some people might take advantage. Anytime they are doing something, they need some incentives, and this might be very difficult. Then the issues of regulatory pressures from regulatory bodies. So companies must comply with certain regulations. For example, if it's the issue of environment, you need to regulate by NEMA, you need to be regulated by NEMA. Issues of competition, the Competition Authority of Kenya. Issues of treating customers, we have the Customer Authority of Kenya, and other issues. Then founders may be sidelined with timely, especially the founders. So sometimes you might be sidelined in the event that we have different shareholders who come to place and they want to take control of what happens in the company. Then we have public companies. We have public companies. Public companies are publicly traded within the open market with shares being purchased by a variety of investors. So different companies have floated their shares so that different shareholders can buy these shares. Remember, we have two forms of shareholding. We have the ordinary shareholding and we have the preference shareholding. So you can either decide to invest in that. Becoming a public company allows the market to determine the value of the entire company through the daily trading. So they decide the market where they want to invest there. their money. They have an advantage with their equity since they are not restricted from selling in future and have increased access to debt. So they can raise debt using shareholdings, using asset financing, using loans from banks, using maybe grants from other organizations and things like that. They are able to raise additional revenue by going public. So they can float their shares or debentures publicly so that people can buy as a way of increasing their capital or revenue. Disadvantages. So greater adherence to regulations requirement is expected, and most of the majority shareholders have limited control. So you do not have control because of the various regulations that you need to adhere to. Failure to do that, then you have some questions to answer. Other conditions to be met, including mandatory reporting of standards. For example, you need to report your financial status every year, the books of accounts, the books of financial positions, and comprehensive income. Then the cash inflows and outflows also you need to report. And shareholders have a right to document and notifications regarding the activities transpiring in the business. So you need to inform your shareholders. And that is why every year you must have an AGM meeting for purposes of explaining the business direction to your shareholders. So what are the factors you need to consider when starting a business? I think let's stop there for today. So that next time when we come, we shall finish up this one. And